You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Bitcoin, Ether, Solana, Doge, and more. Cryptocurrencies and digital assets are taking the financial world by storm. This exploding market provides everything a savvy trader needs: volatility, volume, and liquidity, provided you know how to find it. That's where we come in. Welcome to the Crypto Rundown. Each week, we'll break down the latest trading activity, trends, and developments throughout the world's leading crypto derivatives markets. If it's moving the crypto markets, then you'll find it on the Crypto Rundown. The Crypto Rundown is brought to you by Amberdata. If you're entering the digital asset class, you'll need access to granular on-chain and market data from multiple venues to power research, trading, risk management, and compliance. Amberdata delivers comprehensive data and insights into blockchain networks, crypto markets, and decentralized finance, empowering financial institutions to apply traditional finance methods to digital assets. Amberdata eliminates the infrastructure setup, integration challenges, and maintenance headaches to access digital asset data, reducing cost and time to market to enter the digital asset class. Learn more and download their digital asset data guide at www.amberdata.io. Now it's time to dive into the exploding world of crypto derivatives. It's time for the Crypto Rundown.
All right, everybody. That music means we are back once again with the Crypto Rundown, the program here on the Options Insider Radio Network, where we go a little bit beyond our traditional stomping grounds of your Tesla, your VIX, and your SPY options and all that fun, and explore what's going on out there in those crazy crypto waters. Going to talk the volume, the volatility, the skew, the OI, the big trades, the unusual activity, all that fun, and a whole bunch more. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-engaging, at least we tend to think so, Options Insider Radio Network. Of course, we were off last week for the President's Day holiday. Now we're back and raring to go with a lot more crypto fun. Of course, if you're enjoying this show, head on out there wherever you're listening to this program, whatever platform you're getting it on now. It's pretty much available on every platform under the sun these days. And leave a review if you do like what you hear. It does help folks continue to discover not just the content, but indeed the network. We've seen just a tidal wave of new listeners to this program and indeed to the full network throughout the entirety of last year. It is still continuing in 2023. No doubt in no small part due to all the folks out there who take the time to rate and review. We've been doing this for a while. This January, 16-year anniversary, which is crazy to say out loud, but obviously the new folks do have an impact on all the algorithms out there. If you do like what you hear, do keep rating and reviewing to keep the party flowing out there. And of course, you want to go above and beyond, and who doesn't these days? These markets are crazy. You want more content in your lives beyond just what we're giving you over there on the network side. You want to head on over to theoptionsinsider.com/pro. It's a place to go to great pro Q&A sessions. A lot of great guests from the world of crypto have joined us in the hot seat over there, as well as, of course, for Options Oddities. I checked it the other day, almost 200 exclusive episodes available for you up there on that pro podcast feed. So you can really spend weeks just mainlining that. No bathroom breaks, no food breaks, just nonstop shows for you over there. Of course, live access to this. Everything else we do, great giveaways coming up on the February Pro Trading Crate. Get your name in the hat before the end of the month so you too can win fabulous prizes and a whole bunch more. TheOptionsInsider.com/pro. And now it is time for us to keep on going right on into the crypto hot seat.
Forget about cold storage. It's time to turn up the heat on thought leaders from the world of cryptocurrencies and digital assets. It's time to take their place on the Crypto Hot Seat.
All right, everybody, welcome to the Crypto Hot Seat, the portion of the show where we welcome on guests from throughout the world of crypto, derivatives, and indeed beyond, and proceed to pick their brains for the benefit of you, the listener. Next up is an old friend of the program, our old buddy, Mr. Greg Magadini, the director of derivatives over there at Amberdata. Greg, welcome back to the program, sir. It has been too long.
Happy to be here, Mark. Thank you so much.
Yeah, we're rolling out a special hot seat for you today, Mr. Greg, because usually you come armed with a lot of data, but this time you went above and beyond, sir. You have a whole white paper dissecting all the volatility trends and regimes and finding edge, as you put it, in 4 years worth of volatility regimes. So we have a lot to dive into, Greg, today. I'm excited. You excited?
I'm very excited. I'm super excited to talk about this report. I feel honored to have built it with some of the best in the industry, including one of the Options Insider Network favorites, Ewan Sinclair. So it's cool to have.
Who? I'm sorry. Who is that? I'm not familiar with that name. Who are you talking about here? I'm not familiar with that person. I hear he's a horrible person. That's what I hear, just behind the scenes.
Some of the best Ewan Sinclair interviews are with you, Mark, interviewing him. So I love it.
I've had some fun with Ewan. I haven't chatted with Ewan in quite some time. We'll have to get him back on to pick his brain on all this fun. But yeah, but it was you and Ewan and some other folks who wrote this. Why don't you give us a quick rundown of who compiled all this data with you, Greg?
Absolutely. So Fabio Bissani, he works with me at Amberdata. He was such a good hire. We hired him while we were at GVol. He's an options trader, and so he lives in Italy, and he was trading on Deribit, and so we hired him to be an analyst at GVol, and now he works with me at Amberdata. Total G, crushes it every time. Tony Stewart, who writes the Deribit Insight pieces every week. Tony Stewart runs a family office. He trades on Deribit basically every day. He's an OG crypto vol trader. And then Samneet Chapal of Ledger Prime. I've known Samneet basically since I started GVol, and he is AKA our favorite quant, and he did a lot of cool back tests for this report. So honored to have them all as co-authors.
All right, so let's get into all the fun here. As I mentioned, it's called Bitcoin Options, Dissecting Volatility Trends, listeners, and the subtitle is Finding Edge in 4 Years of Volatility Regimes. And Greg, if folks want to check it out for themselves, maybe they're listening, they want to follow along, where should they go to see the full report?
Yes, they can actually download the report directly, or they could go to our Substack or Deribit Insights. So if they want to see it directly and download a copy, they can go to our Substack, which is going to be at amberdataderivatives.substack.com, and it's one of the posts. Or they can go ahead and go to Deribit Insights and get it from them as well.
All right, let's get into some of the fun. Like I mentioned, a lot of data here, listeners. I do encourage you, whether you're listening as you're listening now or maybe down the road a little bit, to go check it out, because a lot of great data. What prompted this, Greg? I know you're always crunching numbers. You're always posting stuff on your blog and on Twitter and stuff. But what prompted this deep dive, and why this white paper now, Greg?
Yeah, it seemed like a more holistic way to kind of get a bit bigger perspective on the crypto vol markets, especially Bitcoin, since we ran this data with Bitcoin. The idea is we've seen a lot of sort of different shifts. I call them regimes. Some people might argue a different term, but see a bunch of different shifts in the volatility space. So we had kind of like a spot vol, positively correlated regime, and then negatively correlated regime. And we have regimes where the risk reversal skew is more expensive to the call side than the put side, which is sort of the inverse of equities. And then other times when it's more expensive for the put side than the call side. And so we're trying to basically kind of categorize all of this into different sort of volatility regimes, so we can essentially help traders understand, how is vol being priced right now? How has it been priced in the past? What are some of the types of trades that are profitable in this type of regime, and where can we see it going in the future? So that's kind of the thinking around it. And what we've been using is basically our full data set here on Amberdata to really crunch all those numbers. And one kind of last thing that we've done is for Amberdata customers, we provide all the Python notebooks that we built to create this report. And if you want to do the same type of analysis for Ethereum, you can just go ahead and pass Ethereum as a variable in the report in the Python notebooks and essentially regenerate a sister report for Ethereum.
And why this time frame? Why 4 years? Why not maybe, I don't know, back to 2017 and the launch of the futures on CME? Why that particular time period?
Yeah, that is just a data thing. So basically, Deribit is kind of the number one exchange for crypto options. We basically started capturing data back when they just listed Ethereum. So that was back to April 2019. And so that's basically our scope of data.
You only go back as far as you have the numbers, right? So,
exactly.
So that makes sense. We'll get into some of the findings. First, let's get into, obviously, there's a lot of data here. So a lot to unpack. We could probably spend several shows just going through all of this. And again, listeners, I do encourage you to check it out for yourselves. We're not going to do the whole thing justice here on the show today. But as you were crunching these numbers here, Greg, you and the team, looking at some of the data here, what were some of the interesting takeaways or findings that you guys came across?
Yeah. So one of the first things I kind of wanted to quantify was the term structure itself. I remember back in 2017 trading VXX or these VIX ETPs, super low VIX environment, and those ETPs got completely crushed. And so I wanted to kind of figure out in crypto if we can quantify the richness or the cheapness of the term structure, like the amount of steepness in a contango curve or steepness in a backwardation term structure curve. So we wanted to do that. And then we also wanted to, when the term structure is in backwardation, how long does it live in backwardation before it flips back into contango? And so when you have these sort of vol shock moments, can you essentially time it and time the mean reversion back into contango? And when we are in contango, how steep can that contango get? So those are sort of the initial things that we wanted to look at in terms of the spine of the term structure or the spine of the vol surface, the term structure itself. And so that was something that was interesting. Kind of the brief highlights of that analysis is the term structure in the past 4 years has been in contango 77% of the time, backwardation 22.5% of the time. And the time to live, so when we flip into backwardation, the mean time spent in backwardation is going to be 85 hours, but it's been as long as 400 hours and as short as 1 hour, with the interquartile, meaning the 25 to 75% most frequent ones, being 12 hours to 135 hours. So this really gets you a good idea that when we have a vol shock, let's go ahead and wait, call it 50 hours, and then start looking for those short vol bets to come back into contango or at least a flat term structure.
We could do a whole show just on this right here. We get this question a lot, Greg, of like, hey, should I pick up puts? Usually it's around the vol products, right? Of, hey, should I buy VIX puts when vol is in contango, or should I even mess with them when it's backwards? And it's all a long way around to trying to figure this out, right? Trying to figure out when is that collapse? When is that moment when the backwardation goes away and it goes back into contango? Because you can make a lot of money in those moments, but timing that is a very difficult and or precise thing to do. So I love how you broke it down. I don't think I've ever seen anyone breaking down the hours of backwardation before. This is a great way to do it. We should do this in VIX and a bunch of other products as well here, Greg. I think you're onto something here.
I love it. Thanks, Mark.
So yeah, listeners, you want to check out this data. That alone is worth checking out. As you mentioned, the mean time, 85 hours, listeners, is how long we're hanging out in backwardation. And the minimum, like you said, 1 hour. So it could be very brief. And of course, if these terms are confusing to you listeners, again, check out some of our basic educational content we have here on the network that'll get you up to speed. Shows like Options Bootcamp, or in this case, you're talking about futures and futures term structures in our show like This Week in Futures Options. Obviously, a backwardation, the situation where the near dated futures trading at a higher price level than the longer dated. Usually it's something else, which is the opposite, which is contango, which is the price of the futures is a gently sloping upward curve. But sometimes things get wonky. Things get crazy, things get backward. And in this case, you actually have the data here. So the mean is 85 hours. Remember that, listen, that could be a useful data point. So Greg, you already got my attention. I'm already intrigued. What else you got to tease us with here, sir?
Yeah, totally. So one of the other things, kind of, this was a follow-up question, it isn't in the report, but it's relevant to 2023, is when we go into backwardation, if we're in a positive spot vol environment versus negative spot vol environment, what does that look like? I think that's a kind of an interesting question. So one of the other things that we looked at were basically spot vol correlations, meaning when volatility goes up, is that because Bitcoin prices are going down, or is that because Bitcoin prices are going up? So traditionally in equities, stocks sort of climb up and then they crash down, meaning stocks move up slowly, especially indexes. This is very true, and then crash down quickly. And so crypto has been a little bit different. We've had periods where the market crashes quickly, such as COVID, Three Arrows meltdown, FTX meltdown, sort of those episodes. But then we've also had markets where they crash up or they basically FOMO higher. So this was really true in January of 2021 when Bitcoin just recently made new all-time highs and kind of had a rocket ship moment higher. We saw both volatility go up and spot prices go up. So we wanted to quantify those on a yearly basis. And so one of the main things that we saw was that 2022 was the most pronounced relationship, and that was a negative spot vol correlation, meaning that volatility came into the markets in 2022 when the spot prices were crashing lower. So that to me was, kind of an interesting finding, not too surprising, because in a lot of ways, Bitcoin trades like a risk asset, and that's typically how risk assets behave. What's been surprising is sort of the price activity in 2023. So the tight correlation and tight relationship that we saw in 2022 basically got flipped over on its head. Spot rallied very quickly this year so far, and volatility climbed up with the spot rally. So that was a kind of an interesting context and, very timely. We basically released a report, and the second we did, that market decides to flip its relationship. So that's something very interesting to look at.
And we've been noting that here on the show since the beginning of this year, because you're right, for last year was one of the first years since we've been recording this show that we saw negative skew really start to really make itself pronounced out there in a lot of the major crypto assets, Bitcoin, of course, and ETH. And traditionally going back to the early days of the show and going back to time immemorial in the crypto markets, it's usually been the other way. Folks have FOMO, they're hodlers, whatever it is. They're usually biased to the upside. They're usually bullish. So we usually saw a volatility premium for our calls and a discount to the puts. And last year, we didn't see that for quite some time. We actually saw a lot of marked bid to the puts, and it's understandable. We saw quite the sell-off in most of the major crypto assets out there. But that's still, you're right, that does stand out as a very much a highlight year now. In fact, we're starting to crunch the numbers again for this week's show. We are starting to see that changing a little bit again. So yeah, definitely, Greg, an interesting time here from an overall skew and just the relationship, as you mentioned it, of vol to the spot prices. People are trained. They've been trained for years, right, Greg, on VIX. Market goes down, vol goes up, and vice versa. Crypto, a little bit of a different game, different rules of engagement out there, Greg.
Yeah, absolutely. And that's actually, I don't want to jump in the back test yet, but that's actually one of the things that's very interesting because, if crypto is trading like a risk asset, but the spot vol relationships are inverse, well, now you can sort of, from a portfolio context, combine different risk assets and use option strategies to hedge them in really interesting ways. So, in the case of Bitcoin, for example, if 6-month options are more expensive to the call side than the put side, well, you can find another asset that's correlated with Bitcoin that's a risk asset where that vol relationship is inverse. And then you go ahead and buy Bitcoin, sell the call, buy the put, do them equidistant, get a slight credit, and then use sort of that premium to, on the other asset, basically buy the put, sell the call, and pay a slight debit. And now you have sort of two assets that theoretically are correlated, theoretically both have expected value, assuming they're good assets. And now you have like free insurance, and it gets really interesting. So you can combine sort of risk assets together and along with these option strategies. So that's something that we thought was really interesting. One of the other relationships we wanted to look at is essentially like the curvature of the wings. So what we did there is we looked at 25 delta calls and puts, and then we just normalized them to at the money volatility. So basically we did the 25 delta call divided by the at the money vol and the 25 delta put divided by the at the money vol. And one of the really interesting relationships that we've seen is kind of for the call side, everything prior to, say, July 2021, out of the money calls were more expensive than at the money. And then basically throughout 2022, out of the money calls were less expensive. So that started to look sort of like equity calls equity index calls were basically the option market is pricing in lower volatility if we start climbing. But then on the put side, one of the things that was really interesting, and this is really sort of an anomaly of an inefficient market, in my opinion, is that we had two episodes in January 2020 and January 2021, where the out-of-the-money puts, call it the 25 delta puts, traded at the same vol as the at-the-money puts. And so that gets really interesting because you can start doing cool strategies. You can start basically doing 1x2s and 1x3s, where basically buy the 3, sell the at-the-money. And then you have like some really nice convexity embedded in there. And so you're not paying sort of a vol premium for that. And so those situations are very surprising that they were ever in the market. And if they ever come back in the market, those are interesting trades. So that's something else that we spent some time looking at.
I wish we saw that in more developed markets, Greg. It would make for an interesting trading environment. Alas, you're correct. You don't tend to see those too often. If you do, they are very short-lived because the savvy folks out there will take advantage of it in the way Greg described, legging into all sorts of ratios and buying one here, selling two there, and soon that skew will start to look like what you would expect in most normal environments out here. So yeah, there's a lot of data. By the way, I think I mentioned at the top of the show, listeners, but if I didn't, this is all just focused on Bitcoin options. We're not talking ETH or other things here. This is all straight data from Bitcoin options here. So again, a lot of fascinating insights here. Also great visuals. So if you're a visual learner, listeners, again, I encourage you to check out the link. We've tweeted it out. We'll put it in the show notes. I'm sure we'll put it out there when we tweet about the show again later. So if you follow us at Options, you'll be able to see how to get access to this report out here. Well, yeah, Greg, I'm looking not just at your box plots here, but you're also looking at your 25 delta versus your at the money ratio normalized over 30 days. You have a lot of data here, Greg. We can literally do about 3 shows on all this kind of stuff out here, but we'll keep rolling out here. You got your at the money versus realized 30 day. That's always an interesting way to look at vol as well, listeners. Obviously, looking at your at the money vol, you're talking implied. So you're talking the market's best guess of what's going to happen in vol over the next 30 days. Realized, of course, a little bit different. That's what's actually happened. In most traditional markets, you're going to see a premium because no one knows what the future holds. You have to bake in a little bit of wiggle room, a little bit of fudge factor, and that's known as, of course, the volatility premium, the risk premium, whatever you want to call it. Greg, as you were crunching those numbers for Bitcoin options, what did you find over the past 4 years?
Yeah, so that, to me, this is an interesting analysis as well. We're essentially trying to answer the question of are options on average or fairly priced or underpriced. So implied volatility is the best estimate for the next 30 days. Realized volatility is what actually happened over the next 30 days. So what we did is we shifted the implied volatility back 30 days to basically align with the realized volatility that would correspond with the actual options. And so what we did there is we calculated variance risk premium, which is basically the differential between realized and implied. And then we segmented it by different sort of environments. So we wanted to see an environment where the term structure is in contango versus the term structures in backwardation. And so no surprise, but when the term structure is in contango, the variance risk premium is more expensive. It's about, call it plus 15 points. When it's in backwardation, it's about, call it minus 10 points. But there's a huge distribution for both. So even though the means are what they are, there's a lot of variation within that. We did another sort of overlay analysis where, what's the variance risk premium when we're in a positive risk reversal environment versus a negative risk reversal environment, meaning the calls are in positive risk reversal, the calls are more expensive than the puts, the 25 delta calls, and in negative, the 25 delta calls are less expensive than the 25 delta puts. And so what we saw there is that actually that overlay had a similar mean for both. So that wasn't a good filter for options being overall cheap or expensive because the mean variance risk premium was about 10 points for both environments. But when we're in a positive risk reversal environment, the distribution of variance risk premium is a lot tighter. So there's a lot more confidence that you're selling overpriced options in that type of environment. And then lastly, we did two more things. One is we basically took the backwardation versus contango environment with the positive risk reversal overlay. And then the other one is the contango versus backwardation within the negative risk reversal overlay. And so in the positive risk reversal overlay, the tight relationship is even more true. So there's a variance risk premium of about 10 points, but then there's a lot less variance. So if it's in contango, if the term structure is in contango and the risk reversal is positive, typically options are just overpriced, and there's a lot less noise around that assumption. When we are in contango, but the risk reversal is a negative environment, options are overpriced, but there's a lot more noise to that assumption. So that's something that's really interesting. And for backwardation, they are underpriced for both environments. And so we really just kind of wanted to segment and see if we can isolate environments that options are a good sale as opposed to a good buy. And so that was kind of the thinking behind sort of that type of analysis.
I'm just fixated on that first data point here. Just you're very basic. Everything's in contango. Things are normal, Greg. And it still comes out to about a 15-point premium. That's enormous. That's huge. That's a ton. You look at, the S&P, probably somewhere around 6 is the average, I would say. So you're talking 15 points just in this is not backward. This is not crazy time. This is just normal, your random Tuesday in the crypto market, Greg. You're getting a 15. That's enormous. That means I should hang up on you right now, and I should be selling everything with two hands.
Yeah, not to mention right now we're in a positive risk reversal environment, so that's even more true.
It's even more juicy. Yep. Yes, it's even more. It's more data points to back that up. Wow. Yeah, what am I doing talking to you? I'm wasting money right now talking to you here. But wow, yeah, that just leapt off the page at me. You don't really see things that stark. Usually it might be a few points here or there, and maybe there's a little bit of bias. But 15 points when just your random Tuesday? That's a lot, listeners. And again, if all this is confusing to you, make sure you check out a lot of our educational content. We'll walk you through, in this case, talking about risk premium. We have a show that's all about that called Volatility Views, which your buddy Ewan has been on many times in the past. There, Mr. Greg, talking about all things risk premium. You also crunch the numbers on the futures basis. Not a thing we hear talked about too much in the crypto space. Any interesting findings there, Greg?
Yeah. So actually, cash and carry within crypto has been one of the most interesting trades because it's a delta neutral trade, essentially. Your only real risk is counterparty risk, and it actually yields a decent amount. So in traditional markets, cash and carry of gold, for example, that is really closely tied to interest rates. So you're not really outperforming sort of the risk-free rates by, owning physical gold in your warehouse and then selling the future against it. You'll capture a spread, but it's not much of a spread. In crypto, where there's no storage costs, it's all basically flows and assumptions of people who want to get levered long or levered short. The cash and carry trade is actually very lucrative. So the biggest sort of positive environment was in 2021 in the first, I think the first or second quarter. We saw the 30-day cash and carry go as high as 50% annualized. So in practical terms, that means you buy some Bitcoin and then you send it to an exchange like Deribit, for example. This is Deribit data. But, that's closed off to U.S. investors, but just for theoretical, mental exercise. You buy some Bitcoin, you send it to Deribit, and then you sell the exact same amount of futures worth against your Bitcoin. So you own one Bitcoin, you sell one Bitcoin worth of futures on 30-day contracts, futures that expire in 30 days, and then you net a 50% annualized return. And your only true risk is if Deribit goes down, but that's basically it. There's no delta risk to the asset itself. You could even go 120 days out and get a yield of about 40% annualized. And so you're just locking that in. I mean, that's like some of the best hedge fund performance sort of ever. And then you're getting that return with basically no effort. So really interesting. What we've seen over the past 4 years is that, 2019 and 2020 had a lot of variation, especially during the COVID crash. 2021 had a lot of variation because of the FOMO environment. And 2022, everything got compressed and the basis trade is essentially nearly disappeared. We actually have a positive basis now today in the market. So if I look at Deribit, for example, I could see that the spot market for Bitcoin right now is trading at about 23,237. But if I wanted to sell the future for September expiration, I can sell 23,700. So there's about $500 of net premium there. So there is a little bit of a basis, but it's not like it was back in 2021. So that's kind of a very interesting trend and trade.
Yeah, this graph for 2021 does leap off the page. You're right. That's almost not quite a risk-free trade because you always have platform risk. We've all discovered that in the crypto world at the end of the day. But Deribit's a pretty safe one. And you're right that those premiums were pretty healthy out there. It's been fascinating to watch the evolution of the futures term structure. I think a lot of people, myself included, back when they launched the BITO ETP based around the CME futures a few years back, we all thought it was going to be like a VXX, some of these other vol products out there that just get annihilated by negative roll yield. It was going to be a disaster. And we've all learned watching the futures now that they don't really trade that way. We don't really see the same type of aggressive contango structures and the horribly negative roll yield. And as a result, products like BITO have actually fared pretty well. And so it's made it a lot more viable for people. And now looking at some of your data here on this futures basis, I can kind of see the underpinnings of why that is. So yeah, looks like, Greg, we all missed out on early 2021, but I don't know those days. I don't know if we want those days to come back. Those were kind of crazy days, but intriguing stuff nonetheless. Now, Greg, you did make a liar of me with the next page because I just told people earlier this is all about Bitcoin options. And then the very next page, you're comparing Bitcoin to ETH options. So you made me a liar here, sir. What trends did you find in terms of the Bitcoin option volume versus ETH?
Yeah, so this is a nice contentious point between Fabio and I over at Amberdata. He's a Bitcoin maxi, I'm an ETH maxi. So I was pretty excited to see a huge climb in ETH OI and volumes. So 2022 saw a huge increase in block trading for Ethereum options and total OI outstanding. So in 2022, especially around the September proof of stake merge, we saw ETH open interest actually exceed Bitcoin option open interest. And a lot of that flow was being block trades for some crazy call flies. So we saw something like 3,500, 4,000, 4,500 call flies go up a bunch of times. So that created a huge increase in open interest. It created a huge differential between the put call ratio between Bitcoin and ETH. So ETH activity was heavily on the call side, and total volume and open interest actually exceeded for Ethereum. So that was really interesting. That trend, like a lot of these trends, got flipped over on their head in 2023. Today, Bitcoin is again the dominant options options asset on the Deribit venue, and then a lot of the block trading is also back to Bitcoin today. But that was just something that was kind of interesting. I thought that might be more persistent, especially because I'm in the ETH maxi camp. But that is no longer true.
Yeah, I was hoping ETH would keep a little bit of that post-merge momentum a little bit longer than it did. A lot of people seem like, the numbers, it all backs it up here. They were very excited going into the merge. Then the volume has kind of, I wouldn't say fallen off, but decreased a bit post-merge. Some people have come in, called that a big non-event. You could probably argue both sides of that. But it is fascinating to watch. And that's something we have noticed with ETH. You mentioned kind of the optimism of ETH. We have something we have noticed since we started recording this show, and it maintains the case now. Bitcoin, for the better part of the last year, it seems like a lot of the size OI, the size positioning we had a lot of this, I'll call it the optimistic nonsense. A lot of that rolled off the board. And what we've seen with Bitcoin now is it hasn't really rematerialized. A lot of the size positioning is going up around strikes that I like to call relevant, near the at the money, things that are actually meaningful for people as opposed to the 60,000, 100,000, 200,000 strikes we used to see a year or two ago. That was all the rage. ETH still plays a little bit in that camp. Maybe not quite as dramatic, but we do still see, 3,000s open for size with ETH and 4,000. So there is, I guess you can call it a little bit of that inherent optimism still there in the ETH options flow that maybe the Bitcoin folks, maybe they're a little bit more beaten down. They're a little bit more cynical. I'm not sure why it is, but for whatever reason, the Bitcoin folks, they're hanging out nearer to the money. They don't want to get burned again, Greg. I guess that's what it is.
Yeah, exactly.
Once bitten, twice shy. So intriguing stuff there. I could keep talking about that kind of stuff for a while, but you also got into some actual practical real world stuff in terms of back testing a lot of strategies, including one of my favorites, the good old risk reversal, and using that to harvest some premium out there in Bitcoin. So, Greg, what did you find as you were back testing risk reversals in Bitcoin over the past 4 years?
Yeah, so this was an interesting back test. Shout out to Sam Neat for actually kind of executing the back test. And then the inspiration behind the back test was one of Ewan Sinclair's white papers, where he basically did the opposite on equity indexes. So he traded the risk reversal, but it looked to be more profitable to buy the put and sell the call sell the put and buy the call as part of the equity strategy that Ewan devised. And then for us, it's more profitable to sell the call on Bitcoin and buy the put on Bitcoin from a risk reversal strategy. So the back test basically goes back to April 2019. And what we're looking at is a 30-day maturity risk reversal that is delta hedged once a day and then is option rebalanced once a week. And so it looks like basically selling the call and buying the put in the 35 delta space and rebalancing every day is sort of the profitable strategy. And so even if we exclude the outlier performance of the COVID 2020 crash, we still see about 30% profits in Bitcoin terms over the backtesting period. So that means essentially you can be long Bitcoin and then use the risk reversal strategy and you get even more Bitcoin as return. And so you still have that Bitcoin upside exposure, but then this risk reversal overlay earns you even more Bitcoin exposure. So that was something that's really interesting.
And how far out were you typically going with the risk reversals? Were these just straight 30 days or was it a longer time frame?
It was straight 30 days.
Okay.
Yep.
That's pretty easy.
With a weekly rebalance. Yep.
And you were delta hedging it all?
Yep. Delta hedge once a day. So we would rebalance at midnight UTC the deltas and then rebalance the actual options or roll the options Friday at midnight UTC as well.
There you go, listeners. 30 days, selling that 25 delta put, buying that 25 delta call. Add in a little bit of delta hedging. I know that's not for the faint of heart for some of you out there. That may be a bit of a bridge too far, but still intriguing. This is a strategy I've always liked, and especially for crypto and Bitcoin in particular, it's an intriguing one. Obviously, the skew has been a little bit wonky over the last couple of years, moving around, so that makes this strategy more or less profitable at certain times, listeners. But it does sound like you found over time the bullish risk reversal, the selling the put and buying the call, is the way to go. Any other intriguing strategies coming up on your radar over the course of your back test here, Greg?
Yeah, another one that was interesting was basically selling the straddle, so that we already touched on. You're
not messing around. Straight selling the straddle, baby. Diving right into the fire.
Straight selling the straddle, exactly. It's a scary strategy. I don't know that we do it, but we just back tested it, and this is really in line with our variance risk premium analysis. And so 7-day straddles with a 2.5% delta hedge threshold. So if prices move 250 basis points either way, we rebalance the deltas. And so 7-day straddle selling was the most profitable, hugely profitable from January 2021 from July 2021 to end of 2022. We saw a lot of returns there. So that was a very interesting P&L performance.
I'll say it has to be a huge winner. If we were talking earlier about on a quiet Tuesday, there's a 15-point premium. You're selling effectively delta hedge straddle. So you're selling that implied, listeners, and you're pretty much trading that against the realized, that's got to be a huge winner, I would think.
Yes, it was about 150% over the backtest period in Bitcoin terms.
Now, not for the faint of heart, listeners. That's not a strategy you and your grandma can just run out and start blasting away at the money straddles, but informative nonetheless, if a little bit terrifying, Greg.
It at least tells you that you know what you're up against when you're buying vol. Let's say that.
Yes, I like it. Right into it. Bam. Let's just sell some at the money straddles. I sense the hand of you and Sinclair there, guiding you into dark places out there. So yeah, interesting. You also have some interesting data on 60-day correlations out here in Bitcoin.
Yeah. So we look at the correlation, especially in the sort of risk reversal analysis. We want to look at sort of the spot vol correlations over time. And so what we've done there is we look at the 60-day correlation between change in spot prices versus change in implied vol, at the money implied vol. And so the first half of the backtest sample was basically 50-50 between positive and negative spot vol correlations. And really starting around March 2021, the correlation ended up being negative spot vol, meaning vol goes up when prices go down. And so again, that has shifted in 2023, but in this backtest period, we've seen a pretty strong negative spot vol correlation.
And you even expanded, I'm looking back at the risk reversal day, you even expanded it to 35 deltas as well. You weren't content with just 25 delta, Greg. You had to go big with the 35 delta put and the 35 delta call. Well, Greg, I didn't plan on spending the whole show on this, but it's fascinating data. We could probably do 2 or 3 shows. I want to squeeze in a little bit of a Bitcoin breakdown and altcoin universe as well. But before we roll out of your white paper, any other interesting takeaways or maybe some surprises as you were crunching the number? You're like, wow, I didn't expect this, Greg.
Well, actually, on the takeaway side, we did one more backtest that's really interesting. And this is really buying essentially the straddle before CPI release. And so the idea here is that, the crypto vol market has started paying attention to U.S. numbers, especially FOMC and CPI. And so the idea here is you buy a straddle 7 days before the release, and then you close out right before the release. And so you basically are betting on an implied vol pump, and you essentially kind of have implied vol offset your time decay, and there's some P&L there. So the backtest period started in basically November 2021, and the P&L profile of the 7-day options that are closed out right before the release is about 10% in Bitcoin terms from 2021 to 2020. From November 2021 to November 2023. So nothing huge, but it is positive expected value to essentially buy the straddle 7 days before the number release and close out right before the number release, essentially allowing the implied vol to pump up your straddle. So that was something that was kind of interesting and one of the last backtests at the end of the report.
I have to assume you were delta hedging the short straddle. Are you maybe being a little bit lighter on the delta hedging with the long straddle, I'm assuming?
I don't remember what the threshold. Oh, actually, the threshold here is also 2.5%.
Okay.
Yeah.
So you're still aggressively delta hedging. That's interesting. Usually folks own the vol and maybe they want to give them a little bit more room to run. But also you got to pay for that decay somehow, right? At the end of the day. Well, this is fascinating stuff. We'll get back to it at the end of the show here when folks want to discover it. But fascinating, listeners, if you haven't been convinced by now, we've been talking about it for nearly 45 minutes. Go check it out over there at Amberdata as we keep on rolling right on into a quick Bitcoin breakdown.
It's time to explore the latest trending activity, trends, and developments across the world's leading crypto market. It's time for the Bitcoin Breakdown.
All right, welcome to the Bitcoin Breakdown. Greg, I'm already exhausted. We already did a whole show just talking about all the findings from your white paper here. But I got a little bit more left in me here as we break down the action out here in the big dog, which is Bitcoin, looking a little bit bigger than it was. Remember, our last show, listeners, we were off for the holiday last week, actually 2 weeks ago. So if you dial it all the way back to 2 weeks ago, we were at a little bit north of 21,500 on that show, right around 21,580. Coming into the start of the show today, we were at 23,283, up about 1,700 handles over the course of the last couple of weeks. And Greg, I noticed you haven't joined us on this show since those heady days of last November, where we were right in the middle of the entire crypto market going down the toilet as a result of FTX. So a little bit has changed. I'm curious. Obviously, we're rallying this week, but we've also been rallying for the better parts of this year. So I'm curious, what are your thoughts on this aggressive rebound we've seen out there in the crypto space, certainly since the last time you and I chatted back in November?
Yeah, it's very interesting. So after FTX, we had a huge realized volatility crush, and implied volatility was really cheap. And then we opened the gates of 2023. Bitcoin rallies, vol comes back into the market. And essentially, if I'm looking at the options market today, dealers are sort of on the wrong side of this. So starting from 24,500 all the way to 29,000, dealers are net short options. And if you look at the flows between on-screen and block, you're seeing a lot of on-screen traders continuing to buy upside calls here, almost kind of like a GameStop squeeze, not quite, but it's kind of those types of flows where retail is really kind of betting on some further upside. And if I look at block flows, we're really seeing sort of vol being sold at the 25,000 strike, 27,000 strike, and 24,000 strike. So,
you know why? Because they saw your paper and they want to just blast away on all this premium now. You've laid the groundwork for all this institutional vol selling to come, Greg. It's all your fault.
I appreciate that.
So if I go out there and buy a straddle and it's underperforming, it's because of you. Everyone's crushing my vol now. I can't make any money anymore.
I love it. So so that's kind of an interesting dichotomy of flows. So takers are basically takers who are institutional are net sellers, and then takers who are on screen are net buyers. But overall, the dealers are net short if we keep rallying. If we go down in price, dealers are net long. So we're seeing a little bit of loss of the momentum of higher prices, and that's bringing implied vol down, which makes sense.
Let's see what else makes sense out here. Looking at all these numbers. Again, all this data coming at you, courtesy of over there at Amberdata. So if that white paper didn't convince you, listeners, check it out over there at amberdata.io to kick the tires and light the fires on this and all the other data that we're talking about here on the show week after week. That vol out there in Bitcoin right now, the average at the money vol, it's looking a little bit lower still, down about a 45 and about a third. It was about 47 3/4 on our last show 2 weeks ago. So coming in about 2.5 points over the span of the last couple of weeks. And it's still decently frothy, certainly when you compare it to, let's say, what's going on in equity vol, which is about half that. But still, on the flip side, we've seen, obviously, Bitcoin vol get much higher. And this comparatively is a little bit tranquil right now. So we'll see. Maybe it's just all this euphoria out there right now, this mostly rally over the last couple of months. Everyone, I guess, is maybe feeling a little optimistic out there in crypto land. Also, that's reflected in the skew. We're just talking about the skew with all that white paper findings there, listeners. And the skew we've been waiting for a while. Is it going to maybe start tilting positive? And our last show 2 weeks ago, we were hanging out about a -1, which is pretty close to flat, listeners. Not a huge premium there either way. And that's still the case this way, even though it is slightly positive right now, about 0.5 point to the positive direction. So you can say technically we are in positive skew territory, but not a heck of a lot. I think a lot of the crypto market and the Bitcoin market is still kind of waiting for that next shoe to drop out there. Looking at overall size positioning in terms of what's open on Deribit right now, and we're seeing most of it kind of trending a little bit lower since our last show. There's about 181,000 calls open right now. It's down about 6,000. Puts is about 76,000 open. That's down about 4,000. It's not a heck of a lot of new paper rolling in over the span of the last couple of weeks. And in terms of positioning, let's see what's open right now. What are the big top 5 positions out there in terms of strike in Bitcoin options? And as I was saying earlier, we're saying mostly relevant strikes. That is the case, except for the number 1 spot. A little bit optimistic there, even though not quite as, shall we say, crazy out of the money as we used to see back in the day. The 60,000s, the pars, and even 200,000 calls used to be open for size in Bitcoin. Not quite seeing that anymore. But number 5, we have the 24,000 strike, listeners. Actually, we have a tie for the bottom of our list at 12,600 contracts, the 24,000 and the 25,000 strike. Both of them right around 12,600 contracts. Both of them also newcomers to our top 5 this week, and also slightly out of the money. So folks looking maybe a little bit farther up the chain there. Number 3, we have the 26,000 strike with 13,600 contracts open. So 1,000 more there. That's also a newcomer. So a lot of new paper floating in terms of new overall positioning here. Number 2, we have the 23,000 strike, 14,300 contracts open there. That's down about 1,200 from this time last week. And the number 1 size position in Bitcoin options right now, 19,000 strike. That's down about 500, but still leading the dance. Greg, that's probably getting back to what you were just talking about, the retail folks starting to flock into the upside, feeling that FOMO again, Greg.
Yeah, a lot of excitement around this rally, for sure.
Now, let's see if there's any excitement as we keep on rolling. Really quickly on BitO, listeners hanging out about a point higher, close to it of what it was 2 weeks ago, right around a 1440 when we kicked off the show. The ADV coming in a little bit, which is weird, down about 54,000 contracts. It's down about 20,000 from this time a couple of weeks ago. Could this be a little bit of a quiet period here for BitO? And the vol hanging out pretty much unched at about a 51 out there in BitO options. We are coming up against it, though. So I'll save the top 10 positions in BitO, and instead we'll keep on rolling into a top 10 in the altcoin universe.
It's time to move beyond Bitcoin and find out what's moving the rest of the crypto marketplace. It's time to boldly venture into the altcoin universe.
All right, everybody, welcome to the altcoin universe, a portion of the show where we look into everything outside of the big dog, which is Bitcoin, except for right now when we talk about the top 10 from a market cap perspective. Kind of hard to exclude Bitcoin from that conversation. Number 10, we have good old Doge hanging out a little bit shy of 11 billion, about 10.6 billion. Then we got Polygon, number 9 here, about 10.8 billion. Actually, I'm sorry, they're both hanging out about 10.6 billion. Hard for me to read this. This data is so small here, listeners. We got 10.6 for Doge and a little bit north, 10.6 as well for Polygon. And then number 8, the much maligned all these days, Binance USD, SEC, take another look at them. Hanging out a little bit north of those two at about 10.7 billion. So it cost you roughly 10.6 billion to break into the top 10 in the market cap right now, listeners. Back in the beginning of the year when things were looking a little bit more depressed, that was closer to 8 billion. So we have seen a bit of an uptick there. On number 7, we have Cardano hanging out right around 12.5 billion. Number 6, XRP, 19.1 billion. Number 5, USD coin, 42.6 billion. Number 4, good old BNB, 47.6 billion. Number 3, it's Tether, hanging out 70, almost 71 billion. Number 2, you know what it is. It's ETH, 198 billion. And the number 1 out there, the big dog this week, Bitcoin, 450 billion worth of market cap. I know Greg's a big ETH head. I know a lot of you out there are ETH fanatics as well. So let's get into the number 2 from market cap, even though number 1 in a lot of your hearts, it is ETH. And again, kind of following suit with Bitcoin, having a nice little rally over the last couple of weeks since our last show. On our last show, we were just shy of 1,500, about a 1,489. Coming into the start of today's show, 1,624, almost 1,625. So we're hanging out right around 135 handles north of where we were this time last week. Greg, I know you're all about ETH. When you're not talking to me and you're not crunching the numbers on your white papers, you're slinging a whole bunch of ETH. What's been catching your eye in the ETH market? Certainly also participating in this rally since the beginning of the year, Greg.
Yeah, so I think one of the main stories really right now, I mean, we have this Shanghai upgrade coming online. So that's kind of interesting for the ETH space. But in the vol space, really the flows in ETH have been a pretty big disappointment compared to Bitcoin. So if I look at like the weekly volumes side by side, Bitcoin basically exceeded sort of, call it the past years of volumes all the way going back to June of last year, whereas Ethereum has been a lot less. So there's kind of like a little divergence in sort of the option activity and participation, and we're not seeing the same type of dealer positioning in Ethereum as we are in Bitcoin. So, for example, in Bitcoin, the dealer positioning is net short around these levels, so they're going to be hedging on the way up. In Ethereum, it's not the same type of activity. So there's not a lot of takers who are buying vol in ETH like they are in Bitcoin. So that, again, is showing a lack of enthusiasm and not the same sort of tight squeeze for dealers.
Interesting stuff out there. Let's keep on rolling, listeners. Vol-wise, we are seeing that vol come in even more markedly on ETH than we were in Bitcoin. Our last show with ETH, we're a little bit north of 63, about 63 and a quarter. Coming into today's show, about 53 and a quarter. So coming in about 10 handles over the course of the past couple of weeks, which is a lot for ETH. ETH usually structurally a lot more volatile than Bitcoin, and it still obviously is more volatile, but coming in a wee bit over the past couple of weeks. Skew-wise, we're also not seeing that big shift to the positive like we're seeing in Bitcoin. It's a little bit less negative than it was a few weeks ago. A few weeks ago, it was about a -4. Coming into the start of this show, a little bit shy of negative 2.5, about negative 2.2. So still negative, but not much. So, of course, it wouldn't take much to turn things to the positive, but we're still kind of hanging out at that slightly negative to almost flat out there right now from a skew perspective. Volume, I should say, open interest-wise, we are looking a little bit heftier than we were a couple of weeks ago. In terms of calls on Deribit, about 2.5 million open there. It's up about 100,000 from this time a couple of weeks ago. Puts hanging out a little bit shy of 800,000, about 792,000, up about 30,000 from this time a couple of weeks ago. Still are hanging out less than that 4-to-1 calls over puts level. So that's something. You're hanging out a little bit, right around 3-to-1. So a little bit light in terms of calls over puts. We are hanging out at 4-to-1 for the better part of last year out there. In terms of action, where are you folks lining up? What are these size positions out there? Like we said, there's a little bit more, shall we say, optimism, far out of the money interest, call it what you will, in the ETH positioning here. Number 5, we have the 1900 strikes. That one's slightly out of the money, not too crazy there. That has 174,000 contracts open. That's a newcomer to our top 5. I believe that's the only newcomer. Yeah, that's the only newcomer fighting its way into the top 5 this week. Number 4, then we jump up quite a bit, listeners. Number 4, 3500. That has 205,000 contracts open. That's got 28,000 new contracts piling in this week. Number 3, the 4,000 strike. That's kind of leftover vestigial paper. That was open a lot of last year as well. And we saw those, the 3,000s and the 4,000s were number 1 and number 2 for most of last year. The 3,000s kind of went the way of the dodo at the end of last year. The 4,000s, I think there was just so far out of the money, no one bothered to close them for whatever reason. They're still there, 241,000 of them, down 1,500 this time from 2 weeks ago and hanging out at the number 3 spot. Number 2, the 1,800 strike, 241,000 of those. That's up about 6,000. The number 1 size position in ETH this week, 246,000 contracts open at the 1,600 strike. That is up about 30,000. And again, not surprising. That's pretty much the at-the-money strike here this week. So intriguing stuff there. And Greg, I know you and I, the last time we chatted on the show, it was last November. You were, I think, understandably a little bit down on Solana. Solana's actually recovered quite a bit since the beginning of the year. It was below $10. Coming into the show today, it was $22.60, up a little over 2 handles just from where it was 2 weeks ago. So looking a little bit more robust. Have you changed your outlook on Solana, or do you feel still that it's so completely linked to FTX that it's kind of hard for you to get back into it?
So there's the argument that the dev community is still active on Solana, and they're not necessarily related to FTX or Sam Bankman-Fried in any way, shape, or form. And so there's still potential, momentum in projects behind or that are being built on Solana. So that argument does make sense from sort of the all perspective. That market's now delisted from Deribit. I'm personally not interested in it anymore. I mean, I was always kind of an ETH maxi. And so Solana was supposed to be the ETH killer. And I think it's just a long way to go before that happens. And so as far as I'm concerned, I'm going to remain an ETH maxi for the time being.
Yeah, kind of hard to find fault with that. It's intriguing. I was surprised at the resurgence it's shown over the last couple of months. Are you a Solana fan? A Solana devotee out there? Listeners, hit us up. Let us know out there. Unfortunately, Greg, that music means we've run out of time here to crunch the numbers here on the show. But one more time before we go, if folks are intrigued by all that data you guys crunched in that white paper, they want to see it for themselves, where should they go? What should they do?
Yes, please go to amberdataderivatives.substack.com. We have the report listed as one of the entries. And then if you want to visit us on Twitter, it's @GenesisVol. And if you want to visit our website or our web app, it's pro.amberdata.io.
And I hear you're coming from my gig these days. You're a podcast host now. So if folks want to check out your musings on all things crypto, where should they go for that, Greg?
Yes. So we have our podcast on Spotify, Apple, and kind of all the other big podcast platforms, as well as on YouTube.
And what's that called so folks can find it?
Yes. Just type in GVOL in your YouTube platform, and then you'll find that. But the podcast show is called GVOL.io, the crypto trading and options show.
There you go. GVOL.io, the crypto trading and options show. That music means we got to go out of here, listeners. That's going to conclude our broadcast day for today. But don't worry, coming back at you tomorrow with our usual explosion of content. Got our advisors option coming at you, our monthly hit of the advisors option with Mr. Matt, the Oracle from New Hampshire, crunches all that data for us over there in ORAT's land, as well as special guests, as well as for all you pro folks tomorrow, getting a great pro Q&A with Steve Sosnick from Interactive Brokers. Wednesday, of course, for all of you interested in educational content, get your double dose of Options Bootcamp and Options Playbook Radio. Thursday, of course, for listeners of this show, we do touch on crypto again on the CME context on our This Week in Futures Options show. Check that out every Thursday or on demand, wherever you're listening to this show, of course. And then Friday, Volatility Views. Your buddy Ewan's been on there quite a few times, as well as, of course, coming back again for all you pro folks with options oddities after that. Then back again on Monday, another episode of the Crypto Rundown. Stay safe out there, everybody.
The Crypto Rundown is brought to you by Amberdata. If you're entering the digital asset class, you'll need access to granular on-chain and market data from multiple venues to power research, trading, risk management, and compliance. Amberdata delivers comprehensive data and insights into blockchain networks, crypto markets, and decentralized finance, empowering financial institutions to apply traditional finance methods to digital assets. Amberdata eliminates the infrastructure setup, integration challenges, and maintenance headaches to access digital asset data, reducing cost and time to market to enter the digital asset class. Learn more and download their digital asset data guide at www.amberdata.io. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.